Good morning, dear students. On the today's lecture, we are going to continue with our subject, that is ratio analysis. Okay, in the last lecture, we saw the background. What is the need of ratio analysis, or why it is calculated to check the financial soundness of particular business unit. But now, on the today's lecture, we are going to start the types of ratio. There are number of ratios for the financial assessment, but according to your syllabus you have to just focus on the four types. Okay, of the today's lecture we are again going to revise what is the ratio analysis. It is the method or the process by which the relationship of the item of the group of the items in the financial statement are computed and presented. Means if you want to assess any business unit in a one shot or in the one number, then it can be you can say it can be declared with the help of a ratio analysis. It is nothing but the comparison of the financial items with the other financial statements. Okay, it is the important tool for the financial analysis. Why it is important? As you know, in the earlier lecture we studied about it. Why it is necessary? It is necessary to find out the ratios of the particular company, or you can say it shows the financial soundness in a one shot, because every time for the assessment there is not having the too much time to check all the things, and hence you should prefer the ratio analysis to analyze the financial statement of the particular company or the banking unit. It is used to interrupt the financial statement so that strength and weaknesses of the firms, its historical performance and current financial condition can be determined. Means with the help of ratio analysis, you just not analyze the financial intermediaries or the financial statement, but it also identify the strength of the company and the weaknesses of the firm, and it also gives you the suggestion regarding the performance and the comparison of the present performance with the historical performance. This is all about the ratio analysis. I am again going to revise the definition of ratio analysis. It is the method or the process by which the relationship of the items or the group of items in the financial statement are computed and presented. Now, the next is the mathematical yardstick that measures the relationship between two figures or the group of figures which are related to each other and other mutual interdependent. Means what is the ratio? It is the mathematical yardstick that measures the relationship between two figure or the group of figure which are related to each other. There are tools. When you take the example for the ratio analysis regarding any bank's financial statement, then there are number of factors. Some are the balance sheet factors, or some are the off balance sheet factors. So you have to express it in the term of ratios. It can be expressed as the pure ratio, percentage, as a rate. It is the mathematical yardstick, nothing but it is gives the percentage, and that percentage showing your strength of the functioning. The ratio is not the end itself. They are only means to know the financial position of the enterprise or the any banking sector. Computing ratio does not add any information to the available figures. It only reveals the relationship is a more meaningful way to enable us to draw the conclusion therefrom. Means here it is not just the end of itself, it just showing you the financial condition or just gives the quantification of that particular business entity, which help us to identify the position of that financial institution in the market. Okay, now in the next slide we studied about what are the utility of that ratio, how it is useful, what are the want satisfying power of that particular ratio. Is the accounting ratio is very useful to assessing the financial position and the profitability of a enterprise. However, its utility lies in the comparison of a ratio. Utility of a ratio is the comparison may be the one of the following forms. For the same enterprise over the number of years, for two enterprises in the same industry, for the one enterprise against the industry as a whole, for one enterprise against the predetermined standards, and for the inter-segment comparison within the same organization. Means why the ratios is calculated for assessing the financial statement. it is show the same enterprises over the number of years, the two enterprises of the same industry, one enterprises, means it is applicable to the business entities as well as financial institutions. Okay, now we are going to study what are the classifications of ratio. As per your syllabus, just you have to focus on the liquidity ratio, leverage ratio, profitability ratio and activity ratio. Means this ratio, with the help of that ratio, you can easily check the strength of that particular banking institute regarding their liquidity. Liquidity means the cash holding capacity of that particular bank. Leverage ratio is there, profitability ratio is there and activity ratio is there. Now we are start with the liquidity ratio. First of all, you have to understand the meaning of liquidity. Liquidity is nothing but the cash holding capacity. This ratio analyze the short-term financial position of the firm and indicate ability of the firm to meet short-term commitments or the obligations or the liability out of its the short-term resources. Means if the bank is able to meet their short-term obligations or the liability, then their liquidity ratio is to be sound. There are known as the this is also known as the solvency ratio, right? Means liquidity is nothing but the solvency ratio. The ratio of which indicates the liquidity of the firms are current ratio and liquidity ratio. This is also you required for the testing it, or the you can say to analyze this ratio to check the financial soundness. So the liquidity means to meet the short term financial obligations. Now that liquidity is further divided into the current ratios and the liquidity or the quick ratio. Now we are going to focus on the current ratio. It is calculated by dividing the current asset by the current liability. With the help of your current asset and liability, if you take the ratio, then it called as a current ratio. Conventionally, the ratio should be 2:1, means your assets should be greater than your liabilities. Then it will be the profitable for you. Means the current ratio here, just you have to compare or you have to conclude the current assets and current liabilities. The next one is all about, now we are going to study what are the current asset. Current asset in the sense it is regarding to the company. So yes, you have to focus on the current asset in the sense the loans which is distributed by the company there. You can say the physical asset like the bank branch or the other things which is given on the credit basis, like credit overdraft, or you can say the capital raised by issuing the shares, equities. Other than that, the physical asset and the loan distributed by the banking companies are nothing but the current asset for the banking. This was given for the industry, but you have to think for the banking. Okay, the current liability in the sense the deposits, various types of deposit you are accepting from the, you can say accepting from the customer or your account holder. You have to pay it within a specific time, or you can say after some fixed time, but you have to pay it back. So these are your liabilities. The interest paid on that deposit is your liability. The returns or the dividends which is paid on your shares is nothing but your liability. So these are the current asset and current liability you have to consider within that particular financial year. Okay, this is all about the current assets and current liability. The second type of the liquidity ratio is the quick ratio or the acid test ratio. This ratio is between the quick current asset and the current liability, alternative the quick liability. It is calculated by dividing quick current asset by the current liability. Quick asset divided by the current liability. You can see the formula of the quick ratio is there. Mind it the formula guys, because it will be asked for the examination. For the liquidity you should prefer the 2:2 and your asset should be greater than your liabilities. And here the quick ratio is there where you have to consider the quick asset and the current liability. It should be 1:1. It is a conventional given the ratio is the 1:1 is a considered as a satisfactory. This is all about the liquidity ratio. I am again going to confirm that what is the liquidity ratio. Liquidity ratio means to analyze the short term financial position of the firm, indicate the ability to meet the short term liabilities. It also called as solvency, and it is divided into two types, that is current ratio and liquidity ratio. Current ratio, for that you have to consider the current asset with the current liability, and the favorable ratio should be 2:1, means your asset should be double than your liabilities. Okay, what are the assets? Asset is nothing but the loan sides, and the liability means the deposits which you accepted, means the nothing but your liabilities. The quick ratio is there. This is the ratio between quick current asset and the current liabilities. Okay, the formula is given: quick asset upon current liabilities, it should be 1:1. The favorable percentage is given, that 1:1, means it should be available in the same proportion. Which are the quick assets? Quick assets are the current assets and less prepaid expenses and inventories regarding to the business unit. And the quick liabilities are nothing but you have to pay within that particular demand by the customer, means it is the demand deposit, nothing but. Okay. Now the capital structure and a leverage ratio. What is the leverage ratio? The ratio indicate the long-term solvency of the firm, is indicate the ability of the firm to meet long-term commitment. When you think about the liquidity, just you have to focus on the short-term requirement or the short-term commitments. But when you think about the long run, then it is called as a leverage ratio or the capital structure. Means the repayment of the principal on the maturity on the predetermined installment due to debts. Means if you are accepting the deposit for the particular period, for like a fixed period is there, 5 years, 10 years. After that you have to repay that principal with the interest also, and if you are fulfilling whatever the commitment done by that particular financial institute for the long period, then it is called as a leverage ratio. Here you have to consider the long term liabilities. The period of the repayment of the interest during the period of a loan, means a periodic payment of the interest during the period of a loan. This is nothing but the leverage ratio. It is also divided into various types, that is debt equity ratio is there, a proprietary ratio is there, debt and total capital ratio is there, interest coverage ratio, and the debt service coverage ratio. Means these are the some types of a leverage ratio. These are some bifurcation of the leverage ratio is given. Now one by one we are going to start with these different ratio. Now we start with the debt equity ratio. What is the debt equity ratio? The ratio is indicate the relative proportion of the debt and equity in the finance of the assets of the firm. It is calculated by the long term debt by the shareholders fund. Means you have to consider here the proportion of the debt with the equity. Equity means how much shares you are, how much capital you are generating by selling your shares. The debt equity ratio is the long term debts upon shareholders fund. Generally, the financial institution favor the 2:1. The ratio is the favorable. However, this standard should not apply having regard the size and the type of a nature of a business and the degree of risk involved. So just you have to, in this particular slide, you have to just remember the definition with the formula and the what is the favorable. Red debt equity ratio is the ratio between long term debts and the capital generated by the shareholders or the shareholders fund. It should be 2:1. The next one is all about the which are the long term firms. The long term firms is the loan which is secured or the unsecured, like debentures, bonds, loans from the financial institution. Long term fund मध्ये काय काय येणार आहे लक्षात घ्या, which is generated through the sellings or the offerings, debentures, bonds in the market. And shareholder funds, these are the equity shares, capital plus prefer the share capital plus reserve, surplus minus fictitious assets. Fictitious assets in the nothing but, for example, preliminary expenses, past accumulated losses, discounts on the issue and the shares. These are the nothing. These some kind of things or the tools you already studied in the FY BCom regarding ratio analysis in the account subject, right? Now we are going to study what is the proprietary ratio. It is not applicable to the banking sector, but still it is given, so just you have to go through it. What is the proprietary? This ratio indicate the general financial strength of the firm and the long term solvency. Is nothing but the leverage actually, but just you have to consider here the proprietary fund upon the total fund. Means whatever the proprietary invested into that particular business unit and what is the total fund is required for that business unit, the ratio between it is nothing but the proprietary ratio. It is not applicable for the banking but for the others. Now the debt to the total capital ratio. It is applicable to the bank. In this ratio, the outside liabilities are related to the total capitalization of the firm. It indicates that what proportion of the percentage of the capital of the firm is in the form of long-term debts. Means indicate the proportion of your permanent capital. Mind it, permanent capital तुमचं किती आहे आणि is in the form of long-term debts किती आहेत. This is nothing but the debt to the total capital, and here you have to consider the debt which is given for the long term basis. So the formula is given: the long term debt upon shareholder funds plus long term debts. The conventional ratio is 2/3, consider satisfactory. Okay, the next one is the interest coverage ratio. Now this ratio is measure the debt servicing capacity of the firm so far as to fix the interest on the long term loan is concerned. It shows how many times of interest charge are covered by the EBIT, that is nothing but you can say out of which they will be the paid. Means here you have to consider the ratio is measure the debt servicing capacity of that firm. How much debt they can able to provide, किती पर्यंतचं कर्ज, what is the credit creation capacity of that particular firm, it should be consider. It is nothing but the interest coverage ratio. So here you have to consider the debt, you can say the debt or the credit creation facility of that particular bank upon the interest, and that ratio should be the 6 to 7 times consider the satisfactory. Okay, the higher ratio is the greater ability of firm to pay the interest on the profit, but too high may implies the lesser use of a debt. Here just you have to go through the ratio analysis. Some of them is applicable to the banking sector and some of them is just for the business unit. So just in this lecture just you have to go through about the ratio analysis. In the next lecture we are going to study how that ratio analysis is applicable to that particular bank branch. Okay, the next is the debt service coverage ratio. This is the more comprehensive measure to compute the debt servicing capacity of the firm. It shows how many times the total debt service obligation consisting of the interest, repayment of the principal in the installment are covered by the total operating fund. So here the formula is given: EAT, earnings after taxes plus interest plus depreciation plus other non-cash expenses upon interest plus principal installments. So just you have to remember the definition and formula, nothing more than that. Generally the financial institution consider the 2:1 is the satisfactory debt coverage ratio. Now the next content is all about the profitability ratio. Profitability means you have to check that profitability of that particular institute. The ratio measure operating efficiency of the firm and its ability to ensure the adequate returns to the shareholders. Means this ratio is measure the operating efficiency of your business firm. तुमची जी काही कंपनी आहे, तुमची जी काही बँक आहे, तिची ऑपरेटिंग इफिशियन्सी काय आहे, ability to adequate returns to your shareholders, providing the efficient rate of interest to them, is it काय म्हणूया आपण की is it possible for them to giving the higher returns, then the profitability ratio is a high. That profitability ratio is again divided into the gross profit margin, net profit margin and expenses ratio. Just you have to remember this type. There is no need to explain the definition of this. The gross profit margin is there, net profit margin is there. Gross means after the deduction of depreciation from the gross profit you will get the net profit margin, and the expenses ratio are there. Not need to go through it. But the last one is about the activity ratio. What is the activity ratio? Activity ratio is nothing but showing, you can say, these ratio are also called as the efficiency ratio or the asset utilization ratio or the turnover ratio. This ratio shows the relationship between sales of the various asset and the various ratio under the group. Nothing but the inventory ratio, debt turnover ratio, average collection ratio, asset turnover ratio and creditors turnover ratio. This is all about the activity ratio. Just you have to remember the definition. It is nothing but the calculation, or it is assessing the efficiency ratio, utilization ratio or the turnover ratio. This ratio shows the relationship between sales and various assets of the firm. That's it. This is all about the types of ratio you have to consider. On the next lecture, we are going to study how these ratios will be applicable to the banking industry. Thank you. Thank you so much.